This is episode 4 of my beginner trading education series. Today I'll be going over how to enter a trade. I'll be using Roblox cup and handle as an example. This is a cup and handle from May, so this is not financial advice, of course. Nothing I say ever is. And this will be the proper format for entering a trade regardless of any strategy, regardless of cup and handle, or if you're day trading or you're using some type of indicator strategy. This is how you always format a trade if you're a trader. So risk first always. Point number one is stop loss. You always must place a definite point where you will exit at a loss, and you cannot change it. This is something that you must adapt to and get used to. There's no way that if you're changing your stop loss, as soon as you're about to be wrong, you say, no, I can't be wrong, and you're letting your ego get ahead of you. Odds are you're going to let it eat up lots of your profits, and it's not going to result in a profitable strategy. So you have to predefine your loss mathematically, and then logically you have to predefine your invalidation, and you can never widen it for those two reasons, because then it's not predefined. So my points go over risk, but then on the logical side, you also must place your stop loss at a point where your trade idea is fully invalidated. So you can determine a re-entry clause, but that also must be pre-planned. So my point with that is, if you know your invalidation, you also know what triggers revalidation, right? This is very essential, because if you're not pre-planning re-entry, you can get carried away, getting stopped out and then thinking, oh, it still looks pretty good, I'll re-enter, and then getting stopped out again and going, oh, I guess it looks all right, I'll take another shot at it. But the only you're attached to it, you didn't have any pre-plan to act on what is prevalent. So let's go to how to enter. Step number 2. Obviously, you can't place a stop loss before you enter, but you should know where your stop is before you enter and analyze your stop fully before you enter. You need to know your risk. So to enter, you must have a predefined entry. You can leave no room for discretionary entry methods. At least in the way I trade and my perspective, if you have discretionary entry methods, you don't truly know when to enter, right? A stock could come up and you're second guessing yourself. Do I enter? Do I not enter? Or, a stock could come down. Do I enter? Do I not enter? That's not a system. That's not a system whatsoever. You need this part to be systemic. Your take profit can be discretionary, whether you sell at 20%, whether you sell at 30%, whether you sell at 50%, that can be discretionary. But your entry you can't just enter on every candle. You need to have a setup, right? You need to have a method to time the stock before its strong advance. So an example of an entry would be, a predefined entry would be, I will enter 10% of my capital with a 4% stop loss once the stock advances, so this would be the trigger, through the high of the handle from the cup and handle, which would be the base. I will only enter within 1 to 2% of my entry point. If it rallies further and I do not get my entry, I will not trade the stock. Here, I'll swap to the chart and show the entry now. So here's Roblox as an example. Classic cup and handle. If you were to enter here, which is at about 2% rally out of the cup and handle, so within bounds, and you wanted to place your stop loss at 4%, which would be quite tight actually. Historically, when I did do this, when I traded this, I had a 6% stop loss. So we'll just put a 6% stop loss for this. Here on TradingView, there's this cool tool called long position or short position. And what it does is it allows you to set your entry point at the middle, and then it allows you to drag down to where your stop would be. Then it automatically will calculate your risk to reward ratio, which I will get into in a second, right in the middle here. So then you can, say, oh, I want to take profit at 18% and have your trade pre-planned like that. It's very clean. So now you've determined your buy point, your trade risk, your capital risk, which would be 0.4% with 10% capital sizing and the 4% stop loss, right? And you have the data to determine your target, which would be your stop loss, right? Because you derive your target from a multiple of your stop loss. This is another crucial trading framework principle, you could call it, is risk to reward ratio. So I'll be getting into that now with how to take profit. Now, to put simply, to have a very effective trading system, you want to take profit or sell your stock at a multiple of your risk, right? You want to make more than you lose. If you lost 50 bucks on the last stock, you don't want to make 20 bucks this time. You're not making money, right? So that's pretty 1 + 1, right? So if your stop loss is 5%, you could sell at a 2 times or 3 times risk multiple at 10 to 15%. This and how your stock acts as it advances is what determines what you sell. But basing it off of how the stock acts as it advances is a little bit more of an intermediate concept. And as a beginner, I'd recommend focusing on a kind of a strict multiple target, right? You want to say, I'm a 3 times risk multiple trader, or I'm a 2 times risk multiple trader. You want a pretty simple predefined goal as a beginner, because you don't know what factors could change it from 2 times multiple on your risk to 10 times multiple. So you still need to do some learning, and you can still make very good money only taking 2x multiple of your risk, or only taking 3x multiple of your risk. You can make amazing money. That's what a lot of the most successful traders have done, is taken a 2 times multiple of their risk and won 50% of the time and netted crazy EV, or expected value, basically just growth. So now we'll be expanding into risk to reward, which is what I was saying with risk multiple. So risk to reward is the ratio of your risk to your profit. So I'll just do a quick example. 5% stop loss, but price is 15% from your entry. So you're at a 15% gain. This would be a 3 times multiple on your risk. You're risking 5%. You're up 15%. That's 3 times more than your stop loss. This math is really beneficial to making decisions around your trading. It basically determines your style and the actions you take for your style. So you need to figure out what your risk to reward goal is. If you're a day trader, you could have a freaking 1 risk to reward ratio or a 0.5 risk to reward ratio. But if you're a long-term trader and you're taking a 1 risk to reward ratio, what? You're going to risk 50% to make 50% over a year or something? That's not an edge, right? So this is very crucial. It determines your style, determines how you become profitable. So here's some math examples to understand why risk to reward ratio is important. If you have a 2R average return, you would have to drop below a 33% win rate to lose money on your strategy. So if you are only winning 1/3 of the time, you wouldn't even be losing money. It's pretty freaking sweet, right? Imagine being at the casino. Imagine you're playing blackjack and you could do that, where one hand pays for the other 2 hands you just lost. This is why risk to reward ratio formatting is crucial to your strategy and your edge. So another example, if you have a 3R average return, you would have to drop below a 25% win rate to lose money on your strategy. So that means 1 in 4 trades. That's all you'd have to get right to not lose money. How remarkable is that? You could go, you could lose 20 trades in a row and then make 4 trades, or sorry, 5 trades. You could make 5 trades that had your average return be break even after just losing 20 times in a row. So that's why this is crucial. It builds in huge failure, which is important. This is important because if you have a strategy that's 90% win rate, as soon as you stop winning, it is going to collapse like a house of cards instantly. You're going to be down 30%, 40%, 50%, freaking maybe even 90%. So building in failure and knowing how to deal with failure when that time comes is crucial. Okay. And this is also the key to making huge returns in the market, is obviously making more than you lose, right? And then turning that over repeatedly. So if you can make, 0.1% more than you lose, and you make that every single day, that would compound. I mean, I'm not sure exactly what 0.1% over the course of a year compounds into, but that would probably be around 100% returns, or maybe something like that. I can't do compounding math off the top of my head, but you get my point. Is if you can turn over that edge more and more, that's what causes compounding. That's what causes the huge performance that makes an individual trader able to outperform the indexes, the S&P, the NASDAQ, the Russell, the Dow Jones, etc., etc. So another example here, if my average win, my average win is 2.6R, so 2.6 times what I risk, I can use this to guide decisions on when to sell a trade. So if I have a trade at 3R, that's above my statistical average. So securing the win, or securing that trade as a win, would not only be an above average winner, which is awesome, statistically, I'm capturing the positive variance from my average, right? This can go deep into a rabbit hole, but my point is you can use this data to make all types of decisions that are very important, and use it to basically amplify your strategy and your edge. So not only is it crucial at the basic level for a framework, but you can use it to improve your edge. But that's about all I have to say about how to enter a trade. Today I went over stop loss, how to enter, how to take profit, and risk to reward ratio. I hope you enjoyed. If you found value, please like and subscribe.